Hi, it's Jared Friedman from Redwood Financial Planning. Today we're going to talk about socially responsible investing. Investing with an eye toward promoting social, political, or environmental concerns doesn't mean you have to forego pursuing a return on your money. Socially responsible investing may allow you to further both your own economic interests and a greater good in whatever way you define that term. Check this video out to learn more about socially responsible investing. The concept of putting your money where your mouth is first gained widespread attention during the 70s, when such highly charged political issues as the Vietnam War and apartheid in South Africa led to some investors to try to prevent their money from supporting policies that were counter to their beliefs. Since then, a wide variety of investment products, such as socially conscious mutual funds, have been developed to help people invest in whatever ways that are consistent with their personal philosophy. However, individuals aren't the only ones to apply the principles behind socially responsible investing. Many colleges and universities, government pensions and retirement funds, and even religious groups do so to some extent. There are many approaches to what may be also known as mission investing, double or triple bottom line investing, ethical investing, socially conscious investing, green investing, sustainable investing, or impact investing. This is perhaps the best known aspect of socially responsible investing, evaluating investments based on not only their finances, but on their social, environmental, and even corporate governance practices. Screens based on specific guidelines may eliminate from consideration companies whose products or actions are deemed contrary to the public good. Examples of companies that are frequently excluded from socially responsible funds are those involved with things like alcohol, tobacco, gambling, or defense, and those that contribute to environmental pollution or that have significant interest in countries considered to have repressive or racist governments. As interest in socially responsible investing has evolved, the screening process has become increasingly positive. Using screens to identify companies whose practices actively further a particular social good, such as protecting the environment, or allowing a particular set of religious beliefs to exist. Both individuals and institutional shareholders have become increasingly willing to pressure corporations to adopt socially responsible practices. In some cases, having a good social record may actually make a company more attractive to investors who might not have previously considered it. Shareholder advocacy can involve filing shareholder resolutions on such topics such as corporate governance, climate change, political contributions, environmental impact, and labor practices. Such activism got a boost when the SEC adopted the so-called Say on Pay rule as a result of the Dodd-Frank financial reforms. Companies over a certain size must allow shareholders to vote on executive pay at least once every 3 years. Though the vote is non-binding, it could give institutional investors a stronger hand in advocating for other interests. Still another approach involves directing investment capital to communities and projects that may have difficulty getting traditional financing, including nonprofit organizations. Investors provide money that is then used to support organizations that help traditionally underserved populations with challenges such as gaining access to affordable housing, finding jobs, and receiving health care. Community investing often helps not only individuals, but small businesses that may operate in geographical areas that mainstream financial institutions deem too risky. A recent development focuses on measuring and managing performance in terms of social benefit as well as investment returns. So-called impact investing aims not only to further a social good, but to do so in a way that maximizes efficient use of the resources involved, using business world methods such as benchmarking to compare returns and gauge how effective an investment fulfills its goals. And in fact, some have made a case for considering impact investing an emerging alternative asset class. Impact investments are often made directly in an individual company or organization and may involve direct mentoring its leaders. As a result, such unique investments may be more similar to venture capital and private equity and may not be highly correlated with traditional assets such as stocks and bonds. One of the key questions for anyone interested in socially responsible investing is whether to invest broadly or concentrate on a specific issue or area. A narrow focus could lead you overexposed to the risk of a single industry or company, while greater diversification could weaken the impact that you might like your money to leave. Even if you choose to focus on a single social issue, you may still need to decide whether to invest in a specific company or companies, or invest more broadly through a mutual fund or ETF whose objective meets your chosen criteria. Even if you have specific knowledge of a particular field, don't let that blind you to the business fundamentals of a particular company. You still need to keep an eye on how it stacks up as a stock. Also, if you're considering a small company stock that is closely aligned with or furthers your chosen beliefs, don't forget that smaller companies are always more volatile. You could even consider investing in a larger company that has made significant commitments to initiatives in your chosen area of interest and that might have other business advantages. Though they might not have the rapid growth potential of a small company, they often have the resources to acquire other companies or manufacture and market globally more efficiently than a smaller company might. See, that might enable them to have a greater global impact while potentially offering investors a way to help mitigate the impact of a smaller stock, generally with higher volatility. If you don't have time to do detailed research or don't trust your own judgment, you can work with an advisor who has access to more information about your area of interest. Social good may be defined differently by every investor, and even a socially responsible fund may include multiple definitions of the types of companies that meet its investment objectives. So make sure your expectations are clear and realistic. Many socially responsible investments produce solid financial returns, while others may not. Past performance is no guarantee of future results, and you should have a sense of what kind of return you might expect in all investments. However, you shouldn't feel you have to accept mediocrity in order to support your beliefs. Monitor your investment's performance and be prepared to look elsewhere if your investment doesn't continue to meet your needs, either financially or philosophically. The clearer you are about your goals you have for your money, the better your chances of selecting appropriate investments. As always, you can consult with us to discuss socially responsible investing. Thank you for watching. Please subscribe to our channel so you don't miss out on any future videos, and have a great day.